Objective 3 deals with tons of different specific types of tax issues, and it kind of goes through each one of them and gives you the ramification of that topic across the different types of entities. So the first idea is that of double taxation. You probably heard that before. Corporations are subject to double taxation, and that is to say that the corporation pays tax as an entity, but then it also pays dividends out to shareholders, and those dividends are taxable to the shareholders, so the same income gets taxed twice. The book goes through a bunch of different examples here, or at least a couple different examples, showing you how double taxation takes effect. So in this example, this company they have set up has taxable income of $1 million. It pays out all of its after-tax earnings annually as dividends, and then the owner, Nicole, has an ordinary marginal tax rate of 35% and a dividend rate of 15%. So this is an important rule right here for you to remember. Dividends, as well as capital gains, to an individual investor are taxed at 15% if that shareholder's or if that person's marginal rate is higher than 15%. If the marginal rate is 15% or lower, then dividends and capital gains do not get taxed at all. Alright, so that is an important thing to remember for future considerations. So here's how the double taxation works out. Here's the corporation's income, 34%. You can look up the corporate tax rates on the inside cover of your book, but this is the most generally assumed corporate tax rate. That means the corporate level tax will be $340 and the remainder is $660. This is the amount that gets paid out as dividends, which is taxed at 15%. So this is the tax on the dividends, and then this is the combined tax of the entity, okay, or on the entity's income. Corporate level tax, shareholder level tax, total tax. So that is an overall tax rate of 43.9%. If, by comparison, if CCS is organized as a flow-through entity, then all the income is taxed at Nicole's marginal tax rate, because the corporation doesn't pay any tax. The whole million flows through to her, and she pays 35% tax, paying $350 overall in tax, and that's a 35% tax rate. So that's the typical scenario with flow-through entities versus taxable entities. You typically see a lower tax rate from the flow-through entity standpoint, and so that is why the general preference is for entities to be set up as something other than taxable corporations if possible. But there are scenarios in which setting up a company as a corporation will provide a better tax answer, and I'll talk about that well, actually, I'll just do it right now. If you go down to this next example, you can see what if they projected the corporation's taxable income to only be $50,000. Corporations have tax brackets that are graduated just like individuals, whereas the lower amount of income equals a lower tax rate. So if taxable income is $50,000 for the corp, the rate is only 15%. So the corporate level tax is $7,500. The rest gets paid as dividends. The dividend rate is still 15%, remember, because the shareholders' rate was 35%. So here's the shareholder tax on the dividend. So 75 plus 63, that's the total tax now on the $50,000 of income for an overall tax rate of 27. So that's less than the 35 that she would have paid had this been a flow-through entity. So it's really important for shareholders to estimate their corporate earnings when choosing what type of entity to be.